So great to see everybody. Thank you very much for coming. First question, I'm just thinking to just work out who we've got in the room. Who is involved in Flex, investing in Flex currently? Show of hands. Amazing. Who's considering Flex offices? Okay. And so everybody else just interest, is it more? Okay, that's lots of nods with interest then. So that's the audience. I'm delighted to be here. I'm Zoe Ellis-Moore, Space to Places. I'm going to get each panellist to introduce themselves. What I would say is this sector, and all of us have worked in other different sectors of operational real estate. For me, it's both frustrating and fascinating, this sector, to be quite honest. It's frustrating that everybody thinks they know flex offices because they've worked in an office and they know Regis and WeWork. So I think that's a big part of the industry, does get tarnished with that. But why it keeps on, the fascination for this industry for me is there's 228 different providers with 4 or more locations in the UK. And there's lots of providers now growing and scaling. And so that long tail is changing in the industry. And we're seeing more consolidation and really maturity. This industry is slowly maturing. But still, I think part of that fascination for me, it's been around 50 plus years, this industry, back from the premise of business centres. And so, it's ripe to sort of move on much faster pace than like hotels and build to rent and other sectors have really achieved much more maturity. So if you want to find out more, we do have a report, Spaces Places report. It goes into a bit more detail on sort of the maturity of where the sector is. But I think we've got a stellar panel here today, really keen for them to introduce themselves, to say, who they are, why they're in this sector, and, what they sort of are finding with the growth and where we are in the cycle as well. So who wants to go first then? So will you go for it?
Hi, I'm William Stokes. I'm the CEO and co-founder of a business called CoSpace. We are design-led workspace in regional locations, currently in 4, Reading, Stevenage, Milton Keynes, and St Albans later this year.
Hi everyone, my name is Will Beresford. I am the co-founder and co-CEO of TradeStars. It's a private equity-backed owner-operator of commercial workspace. We specialize in creative workspace, so it's slightly different from your traditional office. We have a London portfolio of just over 100,000 square feet of real estate. Business started 2.5 years ago, something like that. Thanks.
Hi, I'm Alexandra Livesey. Formerly ran Clockwise for about 5 years. I now run a business called Little Red Donkey, which really focuses on helping landlords understand the flex market, but also helping flex operators to grow and scale their business.
Hi, I'm Sasha Lewin. I run a business called W Real Estate. We are traditional developers and investors in commercial real estate focused on London, and our portfolio today has about 20% of tenants or space operated under flex models.
Amazing. And I'll go straight for the first question with Sasha to say, understanding your view of flex and why you put it in different buildings, how it works as part of your portfolio. It's really understanding your decision-making process really with flex there.
Flex has, for a lot of people, they still look at flex as you're either flex or you're not flex. And we see this, unsurprisingly, as a much more flexible model. So flex for us is the way that the industry has been evolving, and I think this trend is definitely going to continue, and it's about trying to match the right product to the right building and also trying to find a way to make it work commercially. It's still very difficult for a lot of traditional investment models and therefore investors to get comfortable with the way that flex gets valued and how income gets generated through a flex model. But on the other side, it's clear that tenants are increasingly demanding a more flexible solution in terms of lease terms, in terms of services that are being provided. And so there is this coming together from the traditional funding model to meeting the demand side, which is still a little bit unclear, and different models work for different people, but we are seeing slowly quite clear dividing lines sort of fall apart and models starting to adapt. And so we assess every project individually based on the specific needs, but ultimately it's clear that we're moving towards a more flexible way of working.
And I think that leads us quite nicely on to, I was going to ask now, sort of William and Will, very much from your perspective with your business models now, because it comes down to this, your business models is totally different in some ways, your clientele. You've got sort of very much with CoSpace, you've got big corporates actually taking satellite offices to sort of very much thinking TradeStar. You've got even sole traders there and a variety of mixes on that side. So I suppose understanding, profitability and achieving scalability, how are you sort of with your business models driving margins and creating really a resilient business, I suppose, to both of them?
Okay, so yeah, you kind of touched on our business model, or our product, if you like. We're positioned to service businesses, typically startups, entrepreneurs, sole traders, who are typically Gen Z. So they're young. Often it's their first foray into business, and they're looking for a flexible space to run their, I would say, businesses that are anything other than non-traditional office. So think clothing brands, think beauty businesses, think leisure businesses, etc., etc. That's who we're providing space for. And to answer your question, that's what I think creates our resilience. It's really understanding our market and really differentiating our product from, let's just say, the rest of the more traditional co-working FlexOffice market, and focusing on a niche sector.
Amazing, and I would even describe sort of even light retail as well in some ways, that some of the offering that you've got there. So such a variety and mix on that side.
Yeah, I mean, I 100% agree. We went the other way, which was looking more at professional businesses, and what we wanted to do was aim at the market that was kind of moving from that kind of growth phase to, at some point, they'll go and acquire their own asset. And so that enabled us to create a space that was primarily focused on professional businesses. We have confidentiality with a ton of our tenants, but one of them I don't have confidentiality with is UBS, the Swiss bank, who are our largest tenant in our Stevenage space. And when they approached us, it was kind of this thing of, oh, did I mishear it? Was it UPS? But it was UBS. And it was this, they wanted to create this graduate hub where they realized that they were hiring talent in Stevenage, Luton, these outer areas. And their aim was build a graduate hub where we train people and then we'll bring them to the city. And they kind of embraced this hub and spoke model. So it kind of led directly into our model, which was, okay, let's create these professional hubs in regional locations, but focus on just primarily professional businesses.
Amazing. And I'm just looking at the audience. I think everybody's quite hot in here as well at the moment. So it is a rather hot room.
I left my jacket on. I don't know why.
Yes. But if you do have questions, feel free to, raise your hand at any point, because really keen to, make sure you're getting value out of this. So do pop your hand up if you've got questions as they come along as well. Anthony's already got one. Go for it then. It's like.
So they'll come already, but how are you, have you got any interaction with either debt or equity in respect of Flex investment and how they're considering valuation and that sort of metrics? Maybe Sasha speaks to that on the development side. Finding it increasingly frustrating that values will tend to stick to traditional term and version models when we're not that any longer.
Me too. So at the moment, this is still one of the big hindrances, is how valuations are really treating it. We haven't had enough investment activity buying buildings or trading buildings that have significant flex income. and valuers are finding it therefore really hard to put a number on it, and debt is, a slave to the valuation. They are not interested in making their own kind of views, or they're not able to. I think as more people are moving their portfolios into flex, companies like GPE are tilting heavily into that business model. A lot more data is becoming available. People like Zoe and a few others are also driving more transparency, and I expect that it's going to get increasingly easier. But right now, to value and to demonstrate the income potential from flex. But right now, it's still a big hindrance, and actually, it's one of the reasons that it's not moving as fast as it maybe could. So a lot of developers like me, if they're backed with private equity funding, they have to find an exit, for example. It's very hard to move into a flex operated model because it will take some time to stabilize before you can really get that valuation through. But I think we've got to stick with it and give it time. But it's what it needs.
I think they're also from an operator side, we just got to be a bit more creative and flexible in our solutions. Be it either that I've seen quite a number of really interesting deals happening over the last sort of 6 to 12 months, where rather than a pure management agreement or straight up lease, it starts with the zero base rent that builds up over time, that builds a confidence on both sides, that allows you, by getting close to exit, you are actually having, you can come to a middle ground that addresses that valuation issue. And I do think at some point we will need to look at properly as well the European market on how they are dealing there with the legislation side. We have licenses and leases that then dictated, whereas other European markets don't have those restrictions around it, and making that way easier when it comes to a valuation point. So I think there are different things that will happen. It won't come just directly from the debt side and the valuation side. It will have to come from a regulation side. It will have to come from the deals that we're doing as operators and so on. There are different areas to attacking it.
Did that answer your question there? I think, yeah, on that side. But anybody else shout if you've got questions? Another one at the back there. Go for it.
Can you maybe express your views on leakage, and in particular sort of broker fees, incentive agreements to tenants, and some of the challenges of that, particularly looking through the lens of investment?
Who wants to pick up on leakage there?
Well, I think I'm not going to do a Justin and go and dump on the entire broker industry. So I won't do that. It's a really interesting point, and I think what we're looking at is operators more like, there's several in this room and the ones that that have lower churn, right? If you think of the big guys, and I won't name them, but you can name who exactly I'm talking about, who have these 6-month churn cycles. Well, if you're able to capitalize on a member, and for us, we look at it and go, we want 3 years, right? So the market is no longer, unless you're a bigger occupier, going for those 5 to 10 year leases. So if we can get 3 years, we've got a really good industry benchmark. And so what we look at is, and one of the things we do is, everyone that wants an office typically wants it for 12 months, right? But we'll say, look, sign for cost certainty for 24 months and put in a 12-month break. And typically most people forget about it, and before you know it, it's a renewal, and we're getting towards that 3-year mark, which gets really exciting. But I think it's about working with the brokers to understand, okay, if there's deal flow, great, then there's a lead. But where we get a little bit unstuck is around these multi-year deals, because as far as we're concerned, the introduction gets paid, and then they're our member. It's our job to make sure we deliver a service to them and deliver what they need, otherwise they are going to go elsewhere. If you deliver everything, in theory, then they'll stay and you reduce your churn. So we look at a kind of lower churn model. That's what we try and focus on.
I think I've done hotels for 25 years, and as part of that, I've served my time with Whitbread and Premier Inn. Everyone knows hotels, Booking.com, Expedia, etc. Average rate is about 20% that goes directly to the brokers, who are then spending it on the marketing. So, whatever you do on your marketing spend, especially digital marketing, you're never going to get up to that level. So having worked there you're going to have two approaches. You're either going to go for the low churn, because you are of a small to medium size and you're really working on your brand and really developing your brand, which we're seeing in the hotel sector a lot now from the small to medium size hotel brands that are really actively focusing on capturing and retaining their customers. Or you are really big scale, as I said, like Whitbread and the Premier Inn model, where you just have such a coverage of a market that you can actually go to the brokers and say, I'm coming off your channel. But I think for the majority of operators, you can't get away from the brokers. To say you're not going to be on a broker platform is just not feasible. You're just going to lose too many leads. That means you then have to turn around and really build up a positive relationship. And the moment you have that lead, that client, it's then up to you to really foster that relationship. You know, and average length in our industry of any tenant sits, you know, for some who are not focusing on it, of 10 to 11 months, to those ones that are really focusing on community and everything else, of 3 years plus.
And I think the other one with the data that's recently been released, GPE's results for managed being really fascinating. Average sort of length of stay for managed, 3.5 years they've got it down for. And the other report, the reading, just the Workspace group have also just released their results, that 60% of their leads all come directly to the website. So that's sort of going, they're a really strong brand, like a Premier Inn in the hotel model, where people are going direct. And sorry, Stash, did you want to add something there? Yeah.
No, I was going to refer to the Workspace model because I think they have 6 years plus average stay, not necessarily in the same unit, but within the ecosystem of their buildings. So it's about building relationships and retention, but you're 100% right, and it's something that we are feeling very closely at the moment to the bone. And I guess you can incentivize people with slightly different pricing models, but at the end, if they only want a year's term and they want to move on, you will suffer that if you can't build a relationship with that tenant.
And I suppose the next question in some ways moves on that, Alex, you're delivering very much the day-to-day at the heart of the business with the operations, and bring it back to operational real estate. How do you differentiate between sort of average provider and, you know, the high-performing? How do you, you know, get to that level, and what would you distinguish those characteristics of a high-performing sort of flex space?
For me, it comes back to simple things of a net promoter score, but something that really needs to be third party, consistently happening, double blind, so it's coming straight from your CMS system at various point of a customer journey, going out to them, and you really focus on that delivery. We have some big brands that we would see as premiums that are really shouting about, you know, NPS scores of 40, 43%. And then, you know, you have others who are not shouting about it, you know, that's sitting on well over 70. But we gotta be honest about what is actually, is it professional? Is it external? You know, and is it probably double blind, or are you inviting everyone for coffee and cake and ask them to quickly fill out an online questionnaire, and you reward your teams on it?
Yeah, thank you very much. I'm thinking, actually, we've touched on it as well now, thinking about these different business models in some ways, that there's from co-working to sort of traditional serviced office to very much now we're seeing the rise of managed. Also, there's lots of other players, I call them brand lords. We've got the big players coming in, say the Crown Estates there as well with their offering, to Grosvenor with Flex by Grosvenor, Landsec with Mayo brand, and lots of entering the players. What do you see as sort of the business models, or what's happening with business models in this sector for long-term sustainable growth? And yeah, what's your view on these different business models? Probably Sasha's probably best placed with some of these business models.
It's clear that occupiers want more service, want easy access to space, and this is just a reaction from everybody. Before, you had an option to go into a service office provider, or you took a Cat A lease, and all the landlords have understood that they need to lean into the more serviced approach. So that's going to continue, and that's also when we look at the serviced office sector as a percentage overall, I think it has actually shrunk, but the amount of service space out there hasn't, because landlords are taking over, and there isn't going to be one perfect model. Every building, every sector is going to work quite differently. I mean, we've got very different operators here who are both really successful with their models, and they're going to be in the right buildings, in the right location, and they're going to potentially create hubs where people are gathering around. And some are going to try it and do it very, very successfully, and others are going to probably fail, because that's just how these nuisance industries tend to develop. But we're definitely going to continue on that trend. And there won't be, it's just much more smooth. You know, we're trying to put everything into boxes, saying this is a co-working, this is a flex operator, this is a Cat B plus, Cat B minus. In the end, it's, you know, a tenant doesn't really care about those titles. They just care about where is the building, is it cool, what does it cost, does it serve my needs? And whether they're categorized into A, B, or C, they don't really mind. So I think we're going to lose a lot of these divisions that are really there to just try and, you know, give somebody a niche and focus more on the product.
Okay. Any more questions from the audience? Just a break there, because I'm thinking if we had quite a few people that were sort of just interested in the sector. So I suppose for somebody new into looking at this sector, you know, that they're thinking of investing into this sector, what pieces of advice would you give them? Just that somebody from the audience, thinking of a question that the audience might be thinking their first foray into this, you know, what advice would you be giving?
I take this very controversial view that the industry cares about occupancy. So if you speak to people, everyone cares about occupancy. They always ask, what's your occupancy? What's your occupancy? But where I think people should be looking is revenue occupancy. Because you can have 100% occupancy, but if every single desk is at 50%, you go and bust. So what we look at is, well, what is the actual return metric? So based on your spend, based on your bottom line, what are you actually producing site by site? And then what are you producing from a group level? And it takes you kind of 3 to 5 sites before you hit a level where the group gets dissolved enough that you then start to look at the financials and go, okay, this business model now makes, you know, huge amounts of sense. But I think the key thing is looking at revenue occupancy, because the occupancy metrics can be very misleading based on deals that are cut. And cutting deals to get occupancy is great early days, but trying to then churn people from those desk rates to the higher desk rates doesn't sit very well, and you end up with people leaving because you've increased their rent by 20%. So I think as long as you understand what it is you're trying to achieve from a desk rate, stick to that and try and focus on your revenue occupancy. That's more critical for people looking inwards on the sector.
Amazing. Yeah.
Look, I think you have to be able to justify your investment. And with that, you have to ask yourself about scale. I think it was mentioned earlier in one of the other talks this morning around, you know, questioning whether there's much justification or rationale into investing in this unless you can really achieve scale. If you can only get up to, I don't know, 5, 10, 15 locations, doesn't make sense. And to your valuation point as well, I think this plays a part, because I think right now, especially with all the challenges of the valuations, you have to be able, or you're going to be favored, if you like, if you've got something that you can find scale with, or you've got scale. I think when it comes to valuations, if you've got 1 or 2, 3 of these, you know, locations that might trade very nicely on a facility level, the valuers aren't going to favor it. They aren't going to be super interested in it unless you can prove good trading history and build a brand of scale, which is value in itself.
I think the key piece, first of all, is what's your plan with the asset? Are you buying it to flip it? So you have a clear exit date in 3, 5, 7 years' time? Or is it part of your core fund that you're trying to hold on to and you just trying to create cash flow out of it. If it's the second, then flex is a very strong model for you. If it's the former, you're probably better off at looking one of the big operators who's willing to take a straight lease. But if it's a second, then you are really looking at a flex operator, and that's where you then have to understand what do you want in your building, what are your values, and who does align with it.
I couldn't agree more. And I think what we've seen a lot is landlords who have buildings that haven't let, the agents are being pressured into finding solutions. They say, you got to do a Cat B, you got to find some flex. It's not necessarily automatically the solution. I mean, in many cases, these buildings haven't let because they're in the wrong place. People are not interested to be there. You know, putting in a Cat B doesn't magically change it. But then once you look at the offering, you've got to have a good story. It has to be, people have to understand why they should be going there to this building. And a Cat B sometimes can make the difference because it provides an easier entry point for a tenant to come in. CapEx costs for Cat B have become very, very high, as we all know. So that's been a little bit hindrance for the market. But I think in the end, it's about really understanding what is this building about, what is the offer about, not necessarily choosing the operator just purely on the basis of scale, but on the basis of what product is going to be there. We work with a wide array of different operators and different models but in terms of the operator choice, it's really trying to match the story of the building to the right operator and creating the right environment there. It's just like with a hotel. You know, some 5-star hotels are in the right places at the right product, and others are being different. But I think in time to come, the market will adapt, and there will be some really strong operators with great track record and so much data that will be able to point to an investment and saying, we've got operator X here, they've got 50 locations across London. This is their trading data from all of these. There's all the comp set around on top of that. So we can be confident on how well they will be operating in this building in Mayfair, let's say. And I think investors and valuers are going to start kind of understanding these models a bit better and are willing to underwrite, and lenders in particular, future revenue, just like they do with hotels. If I sign a lease with a Marriott in a good location, I can get that funded on day one. With an office operator today, that's very difficult.
Hopefully that was helpful. Just thinking, we've been told to keep tight on time and everything. Anybody got one last final question or anything? Any burning questions there out in the room? Okay, go for it then. Well, there's two, so we got two more final questions then.
A USP for serviced offices was always, we will offer much shorter terms. The big landlords, minimum 5-year terms, certainly don't knock on our door. Now that a lot of those are coming in a lot, how do you differentiate yourself, particularly when you're marketing to the larger, more sophisticated UBS style occupiers to go for your product where they can get much shorter term certificates from traditional landlords?
Probably two things: operational excellence, being able to deliver really good service, which there's way more of a hospitality culture within the serviced office market than in the traditional real estate market. I think that's probably one of the biggest ones.
Yeah, I was just going to add to that. So if you think about, UBS and Stevenage is a really good example, right? The guys that I deal with are older than me. I'm probably the youngest in the room. But the workforce that they employ are millennials and Gen Z. So it's actually looking at, well, what do their workforce want? And what we've seen is that people like these roll-ups, right? And we're like it in human nature. I would much rather have something that's an all-in cost, even if it costs me an extra 10% for someone to do that, and have to go through it line by line and set up my business rates and my utilities and have someone on site that maintains everything. We think that the value add that we bring is in that full turnkey service. We're almost like their operational staff for the Stevenage location. So similar to what you said, it's all about creating that community and also making sure that everything's taken care of operationally. If you do that right, people will always pay that extra premium.
Amazing.
On that as well, there's also another major factor of fit out, because most offices on the traditional
probably data. Flex operators have way more data on their members than traditional landlords, because we need the data to understand our business, to operate more efficiently, and so on. And quite a few of us have now pivoted and actually created reports that really deal with the needs of those members, and that becomes important for them. You know, how many of my employees are actually coming in? How well is my space used, etc. They don't. There's a multitude. You're nodding your head. I mean, the amount of questions that we're both probably getting through on a daily basis is important. You know, tenants are data hungry to understand how their workforce operates and what needs to change.
Yeah, and what, like, to your point, right, meeting room bookings are a good example. How many people have 3 people in a boardroom, and you're like, okay, well, actually, a 6-person meeting room service is this need. Let's put in 2 6-persons, and we've doubled the amount of utilization that we've got. So looking at how the real estate is actually used, we think is quite critical as well.
And
sorry, I was just going to add as well, going back to your fit-out question. So I spoke on a panel with a woman who was the head designer at Fora, and this was like 3 years ago. And our first site that we did in Reading was very trendy. And we went with like where the market was at. And if you go there, it's very Soho housey. Like, we took a lot of inspiration from that model. And she said something that resonated with me, which was they go for products that are timeless and not trendy. And so that informed our decision from our second site onwards. And I was like, okay, let's strip away all this stuff that's really trendy right now, and let's create a fit out that we can keep for 5 years, refresh it in 5 years, and do a major overhaul in 10 years. And if we can do that, to your point, we then get so much more value out of our fit out. So I stole that from her, that wasn't mine.
And so we just got the final, go. Let's go for a final question in the back there, and one quick one. Hopefully we can get both of them done.
Picking up what Sasha said, and Sasha said Alexander, do you think 5-year money can play in this sector? So 5-year PE money can invest in things like that?
It's tricky if you're starting on a development project, which is going to take you 5 years in any case to get there, and then you want to have an exit, and if a large part of your portfolio of that building is under flex, I think right now that business planner would be quite scared to underwrite. I'd like to think that in 5 years the market has developed where we are better at valuing that income, and I think as a proportion of your offering, it absolutely is something that we are promoting to our private equity partners. But a pure play as a developer on a platform basis, if you're the operator, it's a different investment altogether, obviously.
And just quickly, because I know we're all really hot, especially at the back of the room there. Last final question. Did you want to make that one?
You sort of compare sectors of hotels. Where do you think stabilised maintenance capex as a percentage of revenue, where FF&E will end up? I think it's something that when people look at flex businesses, they always get wrong. That's kind of mispricing that. And part of the reason is the sector's quite immature. Not that many trades have happened from both an investment and occupational standpoint.
I've had that discussion about 5 years ago with a board when I joined this industry, because I was trying to explain the need for an FF&E reserve in a budget and in a P&L of a running operation, even when we've just opened it. I think you have 2 pieces. You have your major refurbs that are really looking at your core infrastructure. And then you have what we would normally call hotel fit-outs. So your hotel room refresh every 7 years, etc. In Flex, you can do that every 10 years, and it's way cheaper. But I do think for a premium offering, if you do get to a good 3% of an FF&E reserve, then you're really holding a premium product. If you have a more budget product, 1% is probably enough for as a replacement value.
Hopefully that answered your question. Thank you so much for getting involved and interacting and asking questions. It's been amazing to have all those questions as well. Hopefully you found it beneficial. I'm going to thank panelists now, but also, I know all the panelists are quite open. If you do got more questions, want to get in contact, I'm sure very much everybody's quite open. But thank you to the panelists here. Thank you for listening.